All right, let's jump right in. We're about to pull back the curtain on the rule book that really every major business in the world uses to talk about money. You can think of it as the global language of finance.
I mean, just think about that for a second. Let's say you're an investor in Tokyo and you're looking at a company based in Brazil. How in the world can you be sure their numbers mean the same thing as the numbers from a company in, say, Germany? Without a shared set of rules, it would just be chaos. It would be impossible to compare anything and impossible to trust.
So, to stop that chaos from ever happening, the world came up with a solution. And it's called the Conceptual Framework for Financial Reporting. Now, the best way to think about this is like a constitution for accounting. It's not going to list every single tiny law, but it gives us the fundamental principles that all the specific rules are built on. And hey, don't just take my word for it. The IFRS Foundation, that's the group that actually issues these standards, puts it perfectly. The whole goal here is to create a common language that builds trust, that fosters growth, and gives us long-term stability in the global economy. So you see, this is about way more than just numbers. It's about making the whole system work. Okay, so what's the ultimate point of all this reporting? And, maybe the more important question is, who is it really for? Let's kick things off with the who. Now, here's something that's actually kind of fascinating. You might think these reports are for the general public, or maybe for the company's own managers, but that's not it. See, managers already have all the inside information. The framework is super clear on this. The primary audience is this group right here. It's the investors, the lenders, and the creditors. Why? Because they're the ones putting their capital at risk, and they need solid, reliable information to decide, should I buy? Should I sell? Should I lend? Or should I just hold on? And focusing on what that audience needs leads us straight to the core objective of everything. And it's actually beautifully simple. The goal is to provide information that is useful for making those big decisions. Every single rule, every standard, every little disclosure, it can all be traced back to this one basic idea. Is this information helpful to someone deciding where to put their money? That's it. Okay, so that word, useful, that's the key. But what does useful actually mean when you get down to it? Well, the framework doesn't just leave that up for debate. It breaks down the whole idea of usefulness into some very specific qualities. So what's really cool is how this is structured. It's like there are two tiers. First up, you've got the must-haves, the fundamental characteristics. For information to be useful at all, it absolutely has to be relevant to the decision, and it must be a faithful representation of what's actually going on. If it fails on either one of those, it's basically useless. Then you've got the enhancing characteristics. These are the things that make good information even better. Can you compare it to other companies? Can you verify it? Did you get it in time to actually use it? And finally, can you understand it? So now that we know the purpose and the qualities of good information, let's get into the actual building blocks. These are kind of like the atoms of finance. Everything a company reports is built from these three core elements. And here they are, the big three. You've got assets, which is basically what a company owns or controls. You have liabilities, that's what it owes to everybody else. And then you have equity, which is simply what's left over for the owners. These three concepts, they make up the entire foundation of a company's financial picture. Let's zoom in on that first one, assets. The definition might seem a little academic, but trust me, every single word in there matters. It's not just something you own, it's a resource you control right now because of something that happened in the past that has the potential to bring you economic benefits later on. So for anything, and I mean anything, to be called an asset on a financial statement, it has to pass this three-part test. First, does the company have a right to its potential benefits? Second, does it control it? Can it decide how to use it? And third, did that control come from a past event, like buying it? If you can't say a big yes to all three, then it's not an asset. Simple as that. Now let's flip to the other side of the coin, a liability. You'll notice the structure of this definition is almost a perfect mirror image of an assets. It's a present obligation that popped up because of a past event, and it's going to require the company to give up something valuable in the future. And yep, you guessed it, it also has a three-part test. Is there a present obligation that the company really can't get out of? Will it end in a transfer of something valuable like cash? And does this obligation exist because of a past event? For example, if you buy supplies on credit, you instantly create a liability. The past event was getting the goods, and now you have a very real obligation to pay up. And that brings us to equity. What I love about this definition is how it's actually defined by the other two.
It's just the residual interest. It's not some complicated measure of what a company is worth on the stock market. Nope, it is simply what is left over for the owners once you take everything the company controls, its assets, and you subtract everything it owes, its liabilities. It's the owner's slice of the pie.
And all of this brings us to, without a doubt, the most famous equation in all of business. Assets equals liabilities plus equity. This isn't just a math formula. It's a statement of pure logic. Everything a company has control over has to be claimed by someone, either by the creditors, that's the liabilities, or by the owners, that's the equity. There's nowhere else for it to go. It always has to balance. So we've covered the why, the what, and the how. But let's bring it all back home. Why does having this detailed global rulebook actually matter in the real world? What's the impact?
Well, the impact is absolutely massive, and it really boils down to these three key areas. It creates transparency, which lets that investor back in Tokyo truly compare the company in Brazil with one in Germany. It beefs up accountability because management can't just invent their own rules to make themselves look good. And all of that leads to economic efficiency. When investors trust the information they're getting, they can channel their money to the best opportunities, which fuels growth and innovation all over the world.
So, what's the number one thing to take away from all this? It's that having a single, trusted language for finance makes doing business cheaper and more efficient for absolutely everyone. When we all speak the same financial language, there's less risk, there's less uncertainty, and there's a lot less wasted effort. That trust ultimately lowers the cost of capital for companies and helps our global markets just work better. So the next time you look at a financial statement, try not to see just a boring page of numbers. See it for what it really is, a story, told according to a very specific set of rules. It's a story of what a company owns, what it owes, and how it's been performing. And now that you know the rules of that language, you're one giant step closer to actually understanding the story.